we now welcome on board Ravi Jakhar, the Chief Strategy Officer of Allcargo Logistics, joining in on the show right now. Ravi, hi, good to have you on the show. Let's try and understand where exactly the business could be headed in FY25. And, just taking a look, revenues from your international supply chain did take a hit in the third quarter, as I understand, because of lower volumes. Tell me, how are the volume trends now evolving, and would you say volumes could have bottomed out?
Yeah, so I think, if you look at the volume trends, they had bottomed out in the Q2 or Q3, and we have actually seen sequentially in the international supply chain business, Q3 profits were higher than Q2. Now, in this quarter, as you have seen, the numbers for January and February have been higher than the last year, and we expect the same trend to continue for the entire quarter. So, Jan to March 24 actually should be slightly higher volume than Jan to March 23. This is driven by marginal expansion in market share, while the markets have remained largely flat. The good part is that they've not been going down now, and we see revival in trade based on all the macroeconomic indicators.
We just had a discussion on the metal sector, and the outlook for the metal sector is quite robust. China is coming back, US has not slipped into recession, India is booming. So how come in last 6 months we've actually seen a drop in volumes? I mean, if the world is doing better, if logistics are in demand more, then why is that there was a degrowth in the first place?
No, there was no degrowth in the last 6 months. We're talking about degrowth in the first half of the financial year compared to the previous years. In the last 2 quarters, the volumes have been stable on international business. Like I said, in fact, this quarter is higher than last year's first quarter as well. Volumes have also sequentially grown in the month of February over January on a trend line basis for us. On the domestic side, we have seen almost 18% increase in volumes the previous year. This financial year also was close to 9 to 10% increase in the volumes. So volumes have remained good on the Indian business as well as on the international business. Like I mentioned earlier, the bottoming out kind of happened possibly a couple of quarters ago, and now it's been a slow and steady recovery in the global trade. And if you look at the macroeconomic indicators, I mean, everything is pointing towards positive, be it the PMI in India, you look at the manufacturing confidence in UK, the numbers in US as well on the manufacturing, everything is pointing towards increasing trade. And so we are quite hopeful that the balanced part of the year, the calendar year, should possibly see increased activity across the world.
Light of that, the kind of optimistic outlook that you have, we have still, despite that, seen margins come under a bit of pressure on the back of the rising costs and the fall in freight rates. So what would be your trajectory or your outlook on the margins now?
Yeah, so like I mentioned, in the previous quarter, we saw margins actually improve in the international business for us. And now in the coming quarters, we believe both trends should continue. We have been optimizing on the cost side, both by use of technology as well as restructuring. And we have also been witnessing volume growth, and expansion in margin should also be led by better utilization of containers on the international supply chain side. So overall, sequentially, steadily, we expect that the financial performance should continue to improve. And like what we've seen in the previous quarter, a similar trend should follow from the first quarter of the current financial year, FY25, until the end of this year. We should see sequential improvement in the international trade. On the domestic trade, volume side has been good. Operationally, we are very strong now. All the issues from the past have all been put to rest. The operational performance has been excellent on the Gati side of the business. And we believe that the commercial performance should also improve as the product mix changes. So overall, both on the international side as well as on the domestic side, this year should be a good year for trade, and therefore should be beneficial to logistics industry and us as well.
I have your breakup of your quarterly EBITDA margins. They were as high as 6% and they are as low as 3%. So when do you go back to margins which you enjoyed, let's say, in FY23 of 6%? The scope to go back to those margin levels?
So I would say that maybe not exactly to the FY23 margins, because they were somewhat characterized by exceptional freight rates prevailing and a few exceptional situations as well. But like I said, there are multiple drivers to the expansion of margins. First, as the volumes grow, our costs don't grow in the same proportion. It's the same 40-foot container, which can possibly carry a couple of cubic meters of additional cargo. So the utilization on the back of improved volumes, improvement in the mix of 20 versus 40 feet containers, all of these operational factors are quite interlinked to the volume. So if we see an 8 to 10% volume uptick from here, which I believe is possible over the next 6 to 12 months, at that inflection point of volume, we should be in a position to maintain better profitability on the LCL side. On the FCL side as well, profitability has already been improving. So overall, I would say over the coming 4 to 5 quarters, we should see a sequential improvement in that. It is unlikely to go back to the exceptional highs of 22 calendar year because that was driven by some exceptional freight rate increases as well. But we should see a robust improvement over the coming quarters.
I understand that, but if I could just encourage you to, let's say, give us a sense. I mean, 6% is not possible because that included exceptional items. 3% is where you think that scope of improvement is there. So where will it eventually settle? Will it be 4 to 5? Will it be 3.5 to 4.5? Where do you think the long-term trajectory will settle for you?
So, we avoid giving guidance in the numbers, but yeah, it should be somewhere in the middle is where we should see the long-term normalized outlook on margins as trade stabilizes.
When you are forecasting a growth of 8 to 10% volume growth, how much of that volume growth could be achieved at the current level of OPEX where you don't have to significantly invest in containers and supply chain and technology?
So the volume that I'm talking about is based on a belief that market should see a rebound of maybe 3 to 5% growth. And on top of that, we've been in a position to expand our market share significantly in the coming 4 quarters. That's a combination leading to a good, 8-9% kind of a growth in the international supply chain business. It does not require any investments from our side on the capital expenditure or any significant increase in operating expenditure.
And currently, what kind of CAPEX commitments do you have for next 12 to 18 months? How much CAPEX outlay do you have?
So in terms of the overall CAPEX, given that both the international supply chain business and the domestic business are completely asset light, we do not invest in any, warehouses, containers, trucks, or any of those equipments. They're all on, procured basis. Warehouses are on lease. Our investments are only towards, CAPEX and technology. We continue to upgrade our ERPs, both in the international and domestic business, where we have proprietary ERP solutions. We continue to invest in, data analytics and building capabilities on automation. But in terms of the overall scale, they would not be very significant. And like I said, the business will continue to remain completely asset light.
Okay, great to have you on the show. Thank you so much, Ravi, for taking the time out and joining in today.
It's a pleasure. Thank you so much.
If you like this video, then like, share and subscribe to ET Now.